the last thing that the Fed and the Treasury want is to destabilize the Treasury market by having a deflationary event. I mean, if we have a spike in unemployment, we have mass layoffs, the stock market sells off, companies are making less money, they're laying people off, their GDP goes down, and there's just not as much money to buy US Treasuries. That's a problem. Why is that a problem? Well, the problem is because we're running massive deficits. We're running $2 trillion plus deficits, $2 trillion plus deficits annually in a time that we're not even in a recession. So that is an issue. The job of the Fed and the Treasury are to keep confidence in the dollar. And they need to keep confidence in the dollar in order to keep selling treasuries, in order to keep running these deficits, because it's not stopping.
In the past year and a half, inflation has fallen from a high of 9% to a range between 2.5% and 3%. However, questions remain about why the Fed is considering lowering interest rates when inflation is still above its 2% target. One critical indicator the Fed uses to assess economic health is the Sahm rule, developed by former Fed economist Claudia Sahm. This rule states that if the average unemployment rate for the past 3 months exceeds the lowest point of the year by more than 0.5%, the economy could be headed for a recession. In an interview with Felix, James Lavish drives home some key central points, including the Federal Reserve's actions, particularly its interest rate policy, which is primarily focused on maintaining confidence in the US dollar and managing the nation's massive debt, rather than strictly adhering to its dual mandate of controlling inflation and maximizing employment. Lavish believes the Fed's job, alongside the Treasury, is to maintain confidence in the dollar, which is essential for continuing to sell treasuries and fund these deficits. He states that stable prices and low unemployment will help sustain that confidence. Watch clips from the interview for further insights into James Lavish's conversation with Felix. Please like this video, subscribe to the channel, and turn on post notifications for more content. Enjoy the video.
But the point of this is that the inflation has been stuck well above 2%, 2.5% to 3% for a number of months now, going into earlier this year. And so you wonder, well, why is the Fed ready to lower rates all of a sudden if inflation is still above their 2% target? It's a good question. The second question is, we did see unemployment rise. It rose above. If you look at, there's one indicator that the Fed really likes to look at. It's called the Sahm rule, and the Sahm rule was created by Claudia Sahm. She was a Fed employee, and she economist, and she came up with this rule after her time there, I believe, or at the end of her time there, and the rule says that if you take the average unemployment rate for the last 3 months and compare it to the lowest point of this cycle of the last year, then if it's more than 50 basis points, more than 0.5% above that lowest rate. So, to put numbers on it, if the lowest unemployment rate was 3.5% and the average the last 3 months jumps over 4%, technically we're in a recession. That means that the unemployment rate is rising fast enough that you are concerned that we're about to have a spike in unemployment. If you look back in time, you can look at charts of unemployment versus recessions, and every single recession, unemployment just spikes right into it. And so, and it happens right after it crests that 0.5%. Okay. So now you're thinking, well, maybe, oh God, this means we're going to go into recession. We tripped the Sahm rule, 2 readings ago, and it looks like we're going to be spiking right into recession. We better lower rates. Is it panic time? And the answer is no. There's a lot going on here. So typically and we heard what Powell said 2 meetings ago. So to lead up to this meeting, you have to think about 2 meetings ago. And he said that the dual mandate has come back better into balance, meaning that they're doing well with the inflation battle. They've gotten inflation down below 3%. It's going towards 2% in his words. I think it's kind of stuck at 2.5%, but we'll talk about that in a second. But the second one is he saw rising unemployment and he's concerned about that. So now they turn their attention to unemployment. So they've had their attention fully focused on inflation. Now they're like, well, now what about unemployment? Let's focus on that. And so going into this meeting, you knew that that was kind of on their mind. Trip the Somme rule, and the second unemployment reading was kind of it was a little bit noisy, but it didn't jump, so that was good news. But then going into this meeting and looking at the press release, you can read through the lines and hear what he said in the press conference afterwards. The press conference afterwards, Powell said, "Look, the unemployment rate, it's stable, but the reason we believe that the influx of many millions of immigrants have they've affected that rate. And so when you have 5, 10, 15, 20 million immigrants, who knows how many there really are, somewhere between 10 and 20 million immigrants come into this country, then unemployment will go up, but it's an increase in labor supply rather than a decrease in available jobs. And that's a big deal."
James Lavish explains that the Federal Reserve's dual mandates are stable pricing and maximum employment. While maximum employment is flexible, the focus is primarily on maintaining stable pricing, defined as a 2% inflation target. Lavish notes that this target seems somewhat arbitrary, possibly influenced by inflation control strategies from Australia or New Zealand in the 1970s. However, the real reason behind this target, he says, is the need to expand the money supply to manage the growing national debt. This expansion allows for future debt to be repaid with cheaper dollars. Lavish also comments on the recent rise in unemployment, triggered by the Somme rule, though he stresses that the Fed isn't overly concerned. He states that Powell attributes the increase to an influx of immigrants, which expands the labor supply rather than signaling job losses. Lavish points to the massive $2 trillion annual deficits. In his view, a deflationary event, such as a stock market decline or corporate layoffs, could reduce demand for U.S. treasuries and undermine confidence in the dollar. Ultimately, the Fed's priority is maintaining this confidence to keep the economy stable and deficits sustainable.
Well, I mean, people are thinking rationally. In a rational world, the Fed ought to be tackling inflation a little bit harder here. And they would be concerned that we're going to have that spike that we saw back in the 1980s, right? We're going to have a resurgence of inflation. And why wouldn't the Fed just cramp down on this and make sure that we don't have asset inflation? Well, the reason is because asset inflation is good for the Treasury ultimately, because the market going up, as long as it doesn't go into a bubble and we have a deflationary crash, the market going up, stair-stepping up is good for them because we are a highly financialized economy in the United States. And so the disconnect is seeing all of this and seeing how we have inflation and why are they not bringing inflation down harder? Well, okay, now let's talk through that. What can the Fed do? Truly, they can raise rates. They can keep raising rates. They could keep raising rates, and it hasn't had the effect that we thought it was going to have. If you think about it, if they're saying that if the neutral rate is closer to somewhere around 3%, meaning that if we get Fed funds back down to 3%, that's not expansionary, and it's not contractionary, right? So it doesn't make them economy contract or expand. It's kind of just level. It just keeps it where it is. If that's where they're trying to get to, if you look back, how much did 5.5% really impact the market? Why did that? If it's over if it's 5.5% is really contractionary, right? Restrictive. If it is the word that we're looking for here, is if 5.5% is really restrictive and they're trying to get back to 3.5%. Well, why is inflation stuck at 3.5%? Okay, there's a few reasons. Number one, we have massive spending coming out of Congress, out of DC. That spending is inflationary. They're spending money, they're just creating dollars to spend money, and you can see the money supply is expanding now. You can pull up M2 and it's expanding, but they're pouring money into the economy, and the majority of jobs that have been created over the last 18 months were from the government. They're not private. So that tells you that spending out of the government is keeping the economy going. Is it fake? It's not fake because it's real, real dollars going into the economy, and people use those in the service sectors, but it's not as productive. The government isn't spending money that's on productive projects and productive, businesses. That's private industry that's doing that. Those are the Elon Musks and, Tesla and all that, or Ford or Coca-Cola and all. As bad as these companies can be, they're the ones who are NVIDIA, they're productive. They're creating products that people are buying and using, and creating productivity out of it. That's an important distinction. So, but because of that, you see inflation just kind of stick at 2.5% to 3%. Okay, that's one thing. The second reason that that means that it's been a headwind for those high interest rates. The second headwind is that it's not really a headwind, but it's just it means that they weren't as effective. Is that we ran zero interest rate policy for a decade and a half. Basically, you had a small period there in 2018, 2017, 2018, 2019 where rates were ticking up, but it wasn't really restrictive. You had so many people borrowing and locking in low interest rate mortgages, low interest rate lines of credit, companies that issued bonds that were very low interest rate.
Meanwhile, at the time of writing, Bitcoin is trading at $62,919, having risen 2.9% in the last 24 hours. The surge follows a significant and unexpected rate, cut by the Federal Reserve, which surprised many analysts. Despite the bullish momentum, it remains uncertain whether this trend will hold. Historically, September has been a challenging month for Bitcoin, with average returns of minus 4.5%. Earlier this month, on September 6th, Bitcoin dropped to $52,542. However, this September appears to be bucking the trend, showing signs of a positive performance. The outlook for Bitcoin in the fourth quarter is also optimistic, driven by an improving macroeconomic environment. Historically, Bitcoin tends to perform well in October and November, fueling further optimism among investors. Tom Lee of Fundstrat has consistently maintained a bullish stance, forecasting that Bitcoin could reach $150,000 by the end of the year. As the market watches closely, the question remains whether Bitcoin will maintain its upward trajectory amid favorable economic conditions. As we come to a close, what are your thoughts on the government's role and the Fed mandate in the present inflation? Do you think Bitcoin can play a significant role in lessening inflation? Or do you have other thoughts? Please share your thoughts in the comments below. Share this video and hit your thumbs on the like button. Thanks for watching, and don't forget to subscribe.